So welcome, Perennial Pride listeners. Thanks for joining me on this podcast today. We have a special guest today, Dave Zook. He's the founder and owner of The Real Asset Investor, a serial entrepreneur. I always love that. It's better than the serial killer, which I usually associate with cereal. So you're a better cereal. You really have a tremendous background experience. I'd love for you to share with our audience as a business person and venturing in the world of alternative investments. So, Dave, welcome to the Perennial Pride podcast, and thanks for joining me again.
Tom, thanks for having me back on your show. I'm looking forward to it.
Awesome. You sound great this time.
All right.
Awesome.
I feel great.
Good. Well, we're going to get into a lot of the conversation. I mean, a lot of the things you do are just tremendous. I've certainly worked with you and your team, top notch. But I wanted to share with the listeners to get started. I mean, your background was born and started with entrepreneurship and business, right? That's how you grew up, right? So you started off. Can you talk a little bit about that history and kind of how you migrated through your journey as a business person and entrepreneur?
Yeah, I had the unfair advantage. I didn't go to college. I was out on the street getting banged around in business, learning at a young age, and my dad was an entrepreneur and a business owner, and so he was very successful, and so I kind of grew up in that environment, so very blessed there. I was involved in the family business for a lot of years. Our family business is in modular buildings, so we build and ship buildings all over the country. As I got into my teens and into my 20s, I started becoming more and more interested in business and started really exploring starting my own businesses, partnering with business owners. I did several of those ventures, and of course, fast forward 10 years, and some of these businesses were doing really well. Got myself into a situation where I'm paying $500,000 a year in tax, and that just wasn't it just wasn't so much fun when I was giving half my money back to the government. And so I got into some of Robert Kiyosaki's teachings and heard him make statements like you can make millions of dollars a year and pay no tax legally. And his CPA, Tom Wheelwright, was saying, if you want to change your tax, you got to change your facts. And so I just started hearing those sort of non-conventional terms and started getting around the right people. And I really got to the point where I changed my facts. And now I got a much different tax situation, since then. That was more than a decade ago. I've many times multiplied my income, and my tax bracket remains down close to zero, somewhere in the low single digit range.
That's incredible. Yeah, and I love that phrase that you got to change your facts. I mean, I meet so many people where they just put their hands up and say, I there's nothing I can do. Right. I can just, my mantra is defer. And someday you got to pay the piper. But obviously you got to learn some new facts to find out that's actually not the case.
Yeah. Well, conventional wisdom tells you if you make a lot of money, you got to pay a lot of tax. Right. And, most people believe that.
Well, that's why growing up where I did, I was on the other end. I was get a good job. Parents were, first generation here, and education was key, and get a job and get on the train, right, to financial freedom in the 60s or whatever it is, arbitrary age they pick. And it was just deferring. So it's a very strong pull for people who are, in the job, working in a job. That's where I was for like 20 years. So I get it. But it's fascinating to know. So you got into outside business, into real estate, which is always, I hear enough about real estate, and I'm certainly a big proponent of it. You lay that leap from a business owner and get into real estate. Can you talk more about that and your experience in real estate? Yeah.
So once I started, kind of getting around those folks, getting around the kind of people that were thinking non-conventional, I quickly realized that I needed real estate. I had early on in my teens, I had made up my mind that I was never going to be a real estate investor, just simply because I saw my dad invest in real estate. I saw him self-manage some single-family homes. I just said, you know what, that's not for me. And so I had to change the way I was thinking. When I got around those folks, I quickly realized that I needed real estate. I needed real estate for not only to build, cash flow and appreciation and all that, but for me, more importantly for me, I needed appreciation. And so I started buying multifamily apartment buildings, bought several hundred of my own, quickly got to the point where I wasn't paying $500,000 in tax anymore. I was paying zero. And, by using strategies like bonus depreciation and cost segregation studies and all that. So, I was able to sort of get out of that trap. And then I realized that there was a lot of other people sort of living in that trap and not knowing that there was a better way. And that's when I started really getting serious about educating people and helping them discover the things I discovered, in the year or 2 or 3 prior to that.
Yeah, no, it's fascinating. And we've talked a little bit about offline, the idea around the tax code. And, you mentioned Tom Wheelwright of, again, kind of changing your mindset around what it was. It's the tax code isn't a bad thing. It's a good thing if you understand it.
Sure.
Right.
There's certain rules. And there's certain rules to the game. And if you follow them, number one, if you understand them, like you said, if you understand them and realize that they're there to fulfill an agenda. What is that? Well, the IRS, the government, the U.S. government wants you to create jobs. They want you to create value. If you deliver massive value, whether that is to provide housing for people, whether that is go find oil or gas or buy new equipment that requires jobs from factories in the United States. So if you provide that value, they will reward you for it. So when you realize that the tax code is really full of incentives meant for business owners and entrepreneurs and investors, it kind of changes your whole perspective on it. And really what we're doing is just using those incentives and doing what the government wants us to do.
Yeah, I love that. It's, we always joke around it sometimes with if you have a 401k IRA, you got a partner with you, and they're going to take whatever cut they feel like at the end of the day. Here, you could actually make them a good partner and help them, sharing the risk with us, and certainly give us some breaks to do it, and certainly help the economy too as well. It's a great thing.
Non-conventional stuff.
Well, that's it. I think it's the willingness to go down that path. I mean, that's what it took me a little while just personally, and I know listeners who are on here maybe are thinking this stuff is just too scary. But as you start learning these things, they're not, right? You just got to get the right mindset and be willing to kind of open up your eyes. So, one of the things, Dave, I know you got into real estate and alternative investments and broaden out. And I definitely want to talk more about that. But if you're talking to some folks who are listening to this, who are maybe their main investment is their house and their 401k, right? This is what I would typically see. What are some things that maybe they ought to, the tax piece is one, but what else should they be thinking about to help them sort of take the next step to learn about alternative investments and kind of step into that world? Like, what advice would you give them?
So just being aware of what, where they're at, what they're investing in, because at the end of the day, we talk about it always kind of makes me chuckle when I hear the term alternative investment, right? Because that's a term that you're talking. Okay, so what does alternative mean? Alternative, one of the definitions for alternative means a derivative of, right? Mm-hmm. And so when you're talking about alternative investments, oftentimes you're comparing it to a Wall Street product, right? So a regular investment is considered stocks, bonds, mutual funds, Wall Street products. Alternative investments are considered the real thing. I mean, you're talking like self-storage and multifamily apartments, like real estate. Like what is more real than real estate? I mean, but still, conventional wisdom tells you that's an alternative asset or a derivative of something. But when you're investing in the paper, that's considered the real thing. It's twisted. But just being aware of what you're doing. Like say, okay, so you can go invest in your 401k. Your 401k, may be invested into a REIT of a bunch of self-storage assets or a self-storage REIT, right? Or you can invest with an operator that operates the self-storage facilities. Like, how close do you want to get to the real thing? The further away you get from the real thing, from the initial asset, the less lucrative that investment is going to be, because every step of the way you're going to have fees scraped off of there. So when you invest in a 401k, you're going to, you could be 4, 5, 6 steps away from the real asset. When you invest in an operator who manages self-storage assets, you're 1 step away from the asset. You're one. If you were 1 step closer, you'd own the whole thing by yourself. So that's just a mind shift. When people think about, okay, well, how do I do that? Well, that's one way you got to think about when you're taking the simple approach and investing in your 401k or a REIT. You're just distancing yourself from the real asset.
Yeah, that makes sense. And I guess it's so funny when you have think of alternative and like natural things. Oh, that's got to be super risky.
Oh yeah, but the paper, the derivatives, and the paper and all that's safe, right?
Right. That's what we've been bred to believe. And even my son, who was in high school, he took an investment class, and everything is centered around stocks, bonds, mutual funds. Sure. There is no mention of a business or an actual physical asset like a home or anything like that. And so that's what they're naturally being trained on. And we just kind of, as a society, grown to accept what that means. But to your point, like, you're as far removed from it as possible.
But no, back to your questions about somebody who, let's say you got a high W-2 income earner who's thinking, okay, how do I get into this? How do I get out of this rat race? How do I get into the place where I don't have to, where the only way that I'm producing income, reliable income, is when I'm at my job physically working. I would say a good attainable goal, maybe not easily attainable, but it's attainable. It's a good attainable goal is to say to yourself, okay, within 5 years, 7 years, 10 years, whatever, you set the number, my passive income is going to exceed my ordinary income, my active income. So I'm making whatever, 200 grand at work. Yep. And my W-2 job. My goal is to get my passive income to be 200 grand a year or more. So that's a very good goal. We're just after the new year, and you could say, okay, here we go. I'm going to set one of my goals is to have my passive income exceed my ordinary income.
Imagine that. And imagine it opens you up for you to actually do potentially something you enjoy doing on a daily basis.
I can't tell you how often I've seen this happen. You get the busy professional, let's say it's a doctor, a dentist, a surgeon, making really good money. He hates his life. He's, the only time he's making money is when he's at the office. So he's at the office a lot. He's sacrificing his time away from home. He's at the office. He's working, 5 days a week, 10 hours a day plus 12 hours a day in many cases, all kinds of hours. And he hates his life. What I've seen happen when people actually do this, when people actually exceed their ordinary income with their passive income column, and all of a sudden they're financially free, they all of a sudden realize that, wait, I actually love doing what I'm doing. They may cut back their hours, but they actually love doing what they're doing. It's their life's work. They're making an impact. They're helping people, and they actually love doing what they're doing now because they're not compelled to, and they got more freedom. So that can quickly flip-flop when you get out from under that sort of slavery mentality, and to break out of that, you need passive income, and real estate can be a great way to get that passive income column built up.
No, absolutely. Yeah. And that's a fascinating thought, right? It once you start relieving some of the pressure because you have the passive income to support it, like you can actually truly enjoy what you're doing.
Sure.
Right? Even if it was what you always were doing. And it's amazing that it could shift that drastically.
Once you don't have to do it anymore to survive, then you actually realize, well, I kind of like this.
That's why I always push my kids. I'm like, you have so many options. In some cases, that's a bad thing, right? You have so many options of what you could do with your life and to produce income and add value to this world. It can be daunting. So what's the easier path? Follow what the conventional wisdom tells you, right? Yeah. It's already set up for me. The road's already paved. Might as well just kind of follow it versus maybe, the harder work is like, what would I actually like to do? And, how would I want to contribute more to this world? And it's a harder thing. So I get it.
Easy and conventional are seldom good long term. When you think about when you start that job and you have to opt out of the 401k plan, if you don't opt out of it, you're automatically in the deal. That's not good. The stuff that's easy, mainstream, and conventional, that's going to get you into trouble. It's not going to be good long term.
Yeah. So it does take some leap of faith, but that's why you talk to, just like when I started out getting educated, meeting other experts like yourself and others and learning, right? And you'll start learning what maybe appeals to you or more aligned to you and your values. And, you just got to explore a bit. So certainly highly encourage that for folks who are interested, and there's tons of resources. But so Dave, migrating from, I know I'm going to shift gears a little bit, but, obviously in your world, you're overseeing a lot of, like you said, sharing this knowledge with people who maybe haven't experienced, we got to figure out another word for real investments, not alternative, like learning about these as options. Like what are some of the things that you've gotten involved with and get excited about in terms of alternative investments, for lack of a better term, right now?
I just had this conversation with an investor of mine this morning who had a liquidity event. Mm-hmm. And he's asking me, hey, I got a couple $1 million. Like, what would you do? What would you invest in? And, so I'm talking him through, like, I would take your situation. Of course, I'm asking him a bunch of different questions. They're like, okay, what was the sale? Was it considered a long-term capital gain, or was it considered ordinary income or passive income? And so I'm getting a clear picture of what, how he's going to be taxed on that. And then, he asked me about, different asset classes that I like. And I said, look, the asset classes that are on our website, the asset classes that we have put together and have, put funds around and, take out to our investors is simply a reflection of my own portfolio. This is the stuff that I invest in. So it's not like I go create a fund for my investor. Mm-hmm. No. I'm creating the investment in an asset class that I want for myself. And then if I really like the asset class, which, most of the time I know that ahead of time, but if I really like the asset class, I know the operator, I like the operator, I just really feel good about, not only the asset class, but also the team, then I'll take it to my investors. And that, that's how that sort of develops. But the asset classes that we promote and that we take out to our investors, we have funds built around is really just a reflection of my own portfolio. Yeah,
that's fascinating. Yeah, it's you're kind of not joking around. It's like you're eating your own cooking, right? And actually it's staying down really well. You're not throwing it back up.
Right.
This is what you live and breathe, right? And you're doing the diligence, connecting with teams and vetting them out and making sure they're viable investments for you and your family's money, right?
Yeah, and so, that can also, change over time. I was in multifamily for about a decade. I sold all of my multifamily, not because I don't like multifamily. I think there'll be a time when we get back into multifamily again. But I transitioned into self-storage. And so our three core asset classes are ATMs, self-storage, and car washes. And, so I look at those, and some of those asset classes are simply just because I got involved in them for different reasons. Self-storage, I got involved in self-storage because I figured out that it was the number one performing asset class, commercial real estate asset class among all of its peers. in how it performed coming out of 2008 to 2010, the Great Recession. So it was the least negatively affected when it went into the recession, and it bounced back the fastest and the furthest after the recession. So that's a good clue. I mean, and then when you look back even further, it had a history of performing really well in a downturn. So I got into this in 2017. At that point, we had 9 years of sort of a bull market. And so I'm sort of looking around thinking, okay, this has got to end sometime. Obviously we had a ways to go yet. There was, there was more to come, but when you can get into an asset class that does well in good times and may do even better in not so good times, that's a good place to be. And so some of the asset classes that I'm involved in have to do with a little bit of timing like that.
Yeah, that's great. And to your point, to test it against times when, things will change, which we know they always will.
Sure.
And we can always get, especially I talk to some younger folks and, that they've only experienced goodness, right? And ups, yep. Right? And never look too far. And it's like one of those, it's the recency bias type thing, right? You forget that some of the stuff goes down.
Yeah.
And things will always change.
And then for a more recent example, it's hard to find value in today's market. I believe that over the next 6 to 18 months, some of that value, you'll be able to find better value in some of these assets than you have been able to in the last couple of years. But that is where we've sort of taken to development. We're developing car washes right now and really getting in there and forcing the value instead of going out and seeing if we can find a stabilized multifamily apartment building or a stabilized self-storage facility. We're going out and forcing value. We're going out and buying a piece of dirt, and we're building a Tommy's Express car wash on that dirt, and then building a business around it, and really, creating a lot of value like that. So, at different times of the market, you just got to transition and make different choices.
Yeah, it's amazing. And my first, and I know you guys are heavily involved with ATMs, which I've been with it. Full disclosure, I've invested with you and your company, and I've had great success with it. But when I first heard it, obviously I remember having the conversation with you. I was just like, really? Isn't this going away? I mean, we're going to cryptocurrencies? I never carry cash with me. Like, who's using these things? But the reality is different, right? Especially across the country.
Not you and I. So who's using these things? Not you and I. I own hundreds of them personally, and I couldn't get cash out of one if I wanted to. The question is, who is, or is somebody? And, it's not you and I. It's not our peer group. It's probably not, any of your listeners, but it's EBT card carriers. It's lower income folks. It's immigrants. It's those kind of people. And when you look at where the fastest growing demographic is in this country, they're one of those groups.
Yeah. So it's providing service to get cash. I mean, because we hear enough around the sort of diversity around this country, and not everywhere we live on. We live on the East Coast, and you think everyone lives this way and have the same access to resources, but the unfortunate reality, it's not true.
The other thing that's interesting is when you go back to the Wall Street Journal in the 90s, they were talking about how cash has got a limited lifetime. It's only going to be around for a couple more years. You had new technologies springing up. You had, and even when we got into this space in 2011, you had Apple Pay and Google Wallet and some of those new technologies. Now you have a whole bunch more, and the use of cash has grown right alongside those new technologies.
Yeah. No, I joke because my eyes, and there's still a large population of the older generation in our country. We've got it really tilted to a lot of baby boomers and such. And I still think of my father-in-law. We love him to death. He's still a cash guy. It's just his comfort level. He's like, I'm not changing any of that. I'm a cash guy, and I can imagine there's still a lot of people kind of in that boat, and they're not going to change. Unless absolutely required.
Well, that's right. And we've seen, continued health in, we do a lot of market research outside of our business. So we always, kind of want to see what's going in the macro kind of landscape and see what's going on out there in the general market. But what's even more telling is what's going on inside of our funds. So we can see how our customers are behaving, and we've seen a nice steady growth over the last 10 years of, people continued to use cash.
Crazy. Unbelievable. Now these and they're all, we won't have enough time to go to too deep a detail, but that's why they, if anyone was interested, definitely we'll get you in touch with Dave and his team. But some of them are a mixture of growth, income, even tax benefits, right? That's kind of a nice trio if you can get it.
Yeah. So, and when you're wanting to diversify a portfolio, and that's why I always like to have these conversations with investors, like what's important to you, because when you take an ATM investment that's primarily going to deliver, very aggressive tax impact, 100% bonus depreciation, and it's going to deliver very strong cash flow, cash on cash return, 24.5% annualized. But there's no equity appreciation. At the end of the 7-year contract, the deal's over, and your equipment is pretty much worthless. Now you take a self-storage investment, and it's almost the opposite. It's like you get modest income, you get modest tax impact, but we've experienced super aggressive appreciation. And, you make, based on our business model, there's a bunch of different ways to make money in self-storage, but our business model is to buy from a mom and pop operator and then force values, many times through development or adding square footage or climate controlled square footage. And then we're getting ready and we're selling it to a REIT. So there's a bunch of ways to make money in self-storage. That's one of them. But in that business model, that's what you get. Very low cash flow because we're spending money, we're building up the asset. Very, pretty modest tax impact, but huge appreciation potential. So there you have those two asset classes side by side. I mean, they're like almost polar opposite.
Yeah. No, and to your point, that's what it is. You mentioned earlier in the conversation around, if your priority and target is, hey, I'm looking for a cash flow to replace my income, right? And so that helps you understand which ones are better suited for you, right? And so that's why you have to have a conversation to figure out what's, I guess, your priority and goals with it, because they're not all built the same and offer the same.
Right, so and every investor has a different story.
Yeah, that's right. Yeah, and so that's why in the world I live in finance, it's personal for a reason. It's different. They come from different backgrounds, so it's fascinating. So any other areas that as we kind of get into 2023 and beyond that you've kind of had a pulse on, and you're getting maybe you don't have anything to offer today, but you're kind of investigating and researching? Anything you can share?
Yeah, so I've been a natural gas investor for the last almost 5 years now. And I'm very bullish on the asset class. The last 2 years now, we've put a fund together. We expect to put a fund together in 2023. That should be opening here in the next couple of weeks. So that is an asset class, a commodity that I'm very bullish on. I started building my position back, almost 5 years ago. And if you follow the price charts, what it was like back then, I can tell you it was lonely back then. It was painful back then. But one of the things that kept me going, I was investing based on my conviction. I knew what was coming. I knew they were, expanding the infrastructure to start shipping internationally. And I saw what the price was domestically compared to the price internationally. And so it just told me that at some point we're going to see much higher natural gas prices. We're enjoying that today. But I was about 2 years early, and it wasn't so much fun back then. But it's a whole lot of fun. It's been performing better than I could have imagined or hoped for, and so we really like the natural gas space right now, and we expect it to have a good long term. We expect it to be a good long term asset for us.
Yeah, and that definitely, from what I understand, has some significant upfront tax benefits based on the incentives provided by the government.
Yeah, and not just. I'm glad you mentioned that. It's not just any tax benefit either. This is one of those rare cases where you can actually offset your W-2 or ordinary income with this kind of depreciation. So you can make that investment and you can write off, let's say around 80% of that investment. So let's say you invest $100,000 into a natural gas fund. Our natural gas fund is going to deliver somewhere close to right around 80% depreciation or deduction the first year. So make the $100,000 investment, write off $80,000 in year one, the rest in year two, against ordinary income. That's what Robert Kiyosaki is talking about. That's one of the ways Robert Kiyosaki, one of the things he's talking about when he says you can make millions of dollars a year and pay no tax. That's the kind of thing you can do to offset your tax liability.
Right. And that's all written in law. It's all legal, right? It's not like we're advocating trying to evade taxes. This is just all written there and just get the right tax consultation for it. But it's all viable options for people. That's awesome. Well, wonderful. That's great. This has been really helpful. Dave, this is you always enjoy talking to you. Always share. You're always open and sharing. I really appreciate it. How best for folks, and you remind me, you're directed at accredited investors only?
Yeah, so we run 506Cs, which means we can only accept accredited investors, and we've got several funds open right now. We've got car wash, we got ATM, self storage. Later on, probably in the next couple of weeks, we'll have a natural gas fund. So, keep an eye on us. We got a brand new website. We got a brand new portal as of last year. And we've got a great team that, is happy to answer any kind of questions you have about any of these asset classes. You can go to our website at therealassetinvestor.com. And if you email us at info@therealassetinvestor.com, somebody from my team will get right back to you.
Awesome. That's great. Well, Dave, thanks again for round two. Appreciate it. Sharing some big nuggets and thoughts and certainly hopefully giving people some direction to step forward and learn more about it. And I highly encourage you to do that. Talk to Dave and his team. Great guys. They really provide just the facts of it so you can make some decisions around this and see if it's a good fit and help you figure out how we can get to your financial goals. So, Dave, thanks for joining me. Appreciate it. And best of luck. We'll talk soon.
Thanks for having me on your show, Tom. It was good to be back.
All right. Take care.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.